Gibbs from S&P Capital IQ is with us. Mark Tepper from Strategic Wealth Partners. Todd Salamone from Schaefer's Investment Research. Todd Lydon from Global Investment Trends. And, of course, our own Rick Santelli. And, Todd Salamone, you like stocks still. You're bullish in part because it is still a relatively unloved bull market, isn't it?
It really is, Bill, and it's despite what we've been reading a lot in various newspapers, blogs, where a lot of strategists and market participants will tell you that there's a lot of complacency in the market, and they're looking at the CBOE Market Volatility Index to come to that conclusion. But we would argue, with historical volatility so low, the VIX is relatively high, in fact. But even if you look at other measurements of sentiment, $93 billion year-to-date going into these alternative investments like hedge funds. And typically people will go that route looking for different assets beyond U.S. stocks or looking for funds that have the flexibility of the short to market. You look in the options market where we're hitting 7 to 8 million contracts in call open interest month after month versus the 3.5 million that we were hitting right ahead of that last 10% correction.
Okay.
Short interest popped on S&P component and Cube components, and we're 10-15% above the levels where we experienced that last correction. So despite what you hear about this complacency, we're not seeing it. And then I'll add April, May, and June outflows among U.S. stock funds among the retail investor.
Mark Tepper, you think we keep going here? Is that right?
Yeah, we think the bull market's going to continue for quite some time. You know, a lot of the bears right now are talking about how forward PE multiples are at about 15.8. And that's in line with historical averages, or maybe stocks are even overvalued. But, you know, we would argue that based on the fact that there are just no investment alternatives out there whatsoever that are going to produce any yield, we could see those valuations expanding up to maybe 17 or so. So, yeah, we think this bull market has plenty of room to run.
You know, Aaron Gibbs, we're going to be getting earnings pretty soon here now that the new quarter has begun. This is going to, if this rally continues, it's going to put pressure on those companies to really deliver, isn't it?
Yeah, right now we're looking at about 6.5% growth for Q2 and overall about 7.8 for the year. So actually the fact that the S&P is up about 6%, we're looking for, you know, maybe 10% by the end of the year for the market. It's not that different. You know, there isn't a huge diversification between earnings and where the market is. So, and again, you know, we're talking multiples. They're well within normal ranges, about 16 forward. I'm sorry, 15 forward, 16 in the past 12 months.
Earnings growth at 10%, you think that outpaces what the market does, or should the market catch up or do better than that?
So I think for the year, earnings will end up about, it's forecast about 7.8. I think the market will outpace it because just looking at forward next year's earnings, we're looking at about 10, 11% growth.
Because if you think that that gets priced in then, as that looks more achievable, that puts the Dow at 18,000 pretty quick.
Yeah, and we're looking, our target for the S&P 500 is 2015. But it's very dependent on can they deliver third and fourth quarter earnings, because those expectations are really high, and that's a big question.
Yeah, I mean, and just looking at the last year, we've hit a new millennial mark every 6 months. So the last 3 millennial marks have come every 6-month period here. Just pointing that out. Tom Lydon, this is seasonally, this is a pretty strong time for the market, but do you think that continues through the summer, which traditionally brings in some doldrums here?
Yeah, you're right, Bill. This week, historically, going back to 1950, has outperformed 72% of the time, so that's great news. But as you were talking about fund flows earlier and giving a shout out to ETFs, equity funds have been losing money, but ETFs continue to bring on new money. And just 3 months ago, the areas that got hit the worst, growth stocks, small, mid-cap, technology, biotech, they're actually leading the charge, not only in volume, but in appreciation today. So if we see earnings continue to beat the way we did in the last quarter, 2 out of every 3 S&P stocks beat expectations, if we continue to see that, I think we're going to continue to go higher.
You know, Rick Santelli, the only real cheers I've heard from the floor so far today came when Argentina scored in its World Cup match.
You know, down here, they didn't even cheer for that. So, you know, it's one of these first day of a new quarter to see bonds moving the way they are in terms of selling off of it, to see stocks moving where it is. We haven't had that many triple-digit gains of late. I personally think it makes perfect sense, and add in, it's not only the end of a quarter, end of the half year, it's a holiday shortened week. It makes a lot of sense. And in terms of how long this could go on, I'll tell you what, I know this might be counterintuitive for those who watch me, but I think the equity game is going to go on a whole lot longer than anybody thinks, because there's many ways to look at whether it's overperforming or not. And I would say that if you look at 2007 at 14,000 in the Dow, 7 years later, up 3,000 points, that's roughly 2.5–3% return. So I look for the market to catch up and not look at that kind of hiccup. And I think we could see growth in stocks just at a much more downsized rate of growth. Remember, when we took out the 2007 high in 2013, that's the year we had our big 30% return. So I think that you could look at it in that way, and it explains that the music could go on for a lot longer.
You know, you're reading my mind, Rick. Ron and Sana and I are going to be on next hour to sort of take a historical look at the market, and I was thinking that very same thing about this catch-up phase where we went through 14,000 in 2007, and it took us 6 years to get to the next millennial mark here. Also, I think we should be looking at the NASDAQ, don't you, folks?
There you go.
Right?
There you go. So you're with me.
If anything,
so your negative return, anything from 1999 on is negative return.
If anything's playing catch-up, Mark Tepper, don't you think it's the technology stocks? They hit their all-time high back in 2000 at 5,100, and we are 5,048 or whatever it was. We're still trying to catch that number right now.
Yeah, I mean,
much
the technology
slower to get the millennium levels too.
Yeah, the technology sector looks great, as does energy. You know, what we found is that history has typically told us that, you know, really at the onset of policy renormalization, that's a good time to begin shifting into more of a barbell portfolio strategy. So within the cyclicals, we really like, you know, energy and technology right now. We're starting to pull back and pull out of industrials and materials because they appear to be overvalued. And we're actually beginning to, you know, start to move into more of the defensive sectors again, like utilities, and also consumer staples.
Yeah, but they're not cheap, Mark.
Right. No, utilities have had a good year so far, but they are beginning to look attractively valued again. They just recently retested a relative performance low that they tested twice at the beginning of the 2000s, and both of those times, as well as this time, turned out to be a good inflection point for some outperformance from that sector. So they still look pretty attractive for, you know, investors are chasing yield, and you can pick up pretty good dividends in utilities.
Okay, you know, Tom Lydon, again, people are going to look at this, think they've sat out, think they've missed it. You know, the message from Rick and from others is get involved.
Yeah, that's right, Kelly, and you mentioned valuations. It might be getting a little pricey. So you look for other areas. If our economies continue to move along here, emerging markets have been unloved. You know, with a PE of a little over 11 compared to 17 here in the U.S., relatively cheap, and then we can't forget about Europe. Europe's monetary policy is going to continue to move that economy along, continue to move markets along there as well, but watch out for the currency adjustment there. It's important. It's ETFs that can help you with that.
Aaron Gibbs, what do you guys at S&P think about the technology stocks? I mean, as Rick and I are talking about them trying to play catch-up at this point, where do you rank them right now?
So they're actually fourth in line for earnings growth, and as valuations, they're pretty much middle of the road. So for us, it's very much a stock picker's market. We like some of the stocks they showed earlier, your Apples, your Intels, really the now old school technology stocks. But we still feel that a lot of these higher growth stocks could prove to be a little highly priced. The one thing I would say is that because consumer sentiment has been peaking recently and it actually crossed over the 85 mark, that's where I'd be a little more willing, where we really see that optimism come in. That's where I'd be more willing to come in and take some riskier bets.
All right, guys, thank you for now.
Thank you,
Appreciate
everybody.
it.
Yep.